Another important aspect which we may have to look at is especially when we are applying some portfolios, creating investments of two or more securities. Right, when we talk about a portfolio, is nothing but it's a combination of two or more securities for a risk mitigation purpose. When I take some amount of fixed deposit and at the same time put some amount of my money in a stock market, I'm actually diversifying. And we have seen in our quant calculations also the the return on a portfolio as well as the risk of a portfolio. Let's say here I am taking two different investments. I'm talking about two different investments, A and B. Let's say the A is giving a return of 15% and B is giving a return of 20%. And let's say the standard deviation of the A is, let's say, around 20% and standard deviation of B is 30%. So the higher the risk, higher is the expected return from them. Now I want to combine these two things and create a portfolio, which means if I put 100% of my money A, probably I can expect a 15% return with a risk of 20%. If I put 100% of my money in B, I may get 20% return with a risk of 30%, which means the chance of losing is, I mean, the average deviation from the mean, the average loss could be to the extent of 30% from 20%, which means it could be minus 10 or 50 on an average. So on an average is that much, means probably it could be slightly more than that. So we can probably think about a 95% interval. What is the 95% interval for me? Mean plus or minus 1.96 times the standard deviation. Correct? So probably 20% if it is a normal distribution. And as we have defined, returns generally follow a normal distribution. If the returns are generally following a normal distribution, we can very well talk of 95% confidence interval for the return as 15% plus or minus 1.96 times 20%. That is the typical way we talk about. I am 95% confident that the returns will be between this and this. If you remember, we have solved one of the returns related example also, average 4-year returns. Find the interval for that. So if the standard deviation is high, probably we can see that standard error also will be higher, and probably the 4-year average also will be much more wider. Now for me, the typical question that will come out is, if I combine these two securities in some proportion, let's say 40-60, 40% in A, 60% in B, for the purpose of diversification, right? What will be my portfolio's risk and portfolio's return? So individual risk and return are these. Portfolio's risk and return, then how much will it be? If you remember, in our quant we have used the calculation saying the portfolio return is nothing but the weighted average returns. W1 R1 plus W2 R2. So 40% of the return which you are getting in the first security and 60% of the return which you are getting in the second security. So let's say here I will create a scenario wherein I'll present it in a Excel based format for you, so that See, let's say I'll talk about different scenarios. I put 0% of my money in the first security, 10%. Like that, I'll take various scenarios up to 100%. I'm putting 0%, 10%, 20% in the first security, which means in the second security, I'm depositing the remaining money. 100% here, something like this. Now, what should be my portfolio risk? Portfolio return W1R1 plus W2R2. So, W1 is this weightage into R1, the return of A, plus W2 R2. This is fine. So, if I put 100% of my money in B and 0% in A, my portfolio return is going to be 20% only, which is nothing but B's return. Now, the same logic, probably if I take it down, this is my expected returns. If I put 50-50, 50%